Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets. Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we're going to update you on our view on the Canadian housing bust that we first discussed in February of 2025. Housing is not my forte, I'll admit, but there's some great people covering Canada's national pastime, and so I've leaned on them for some charts and a better idea of what's going on from coast to coast. I'll add my 2 cents on why it's different this time and whether or not more rate cuts will save the housing market, as well as touch on the risks for further decline in housing and what it might do to the credit market and why IceCap continues to shy away from these related corporate credit facilities and private real estate funds. So as many of you know, housing has been a sore spot for anyone under the age of 60 for a long time. If you're not a boomer, it was the most important issue in spring's election, and for years, younger Canadians have watched house prices climb out of reach as successive governments have made promise after promise to make housing more affordable. They clearly failed. I'm going to rip through why housing soared because this week's video is about the crash, but I want to stress that economic phenomenon is never just the result of one thing. Clearly, the Liberal Party's insane immigration policy helped demand outstrip supply for housing. And most Canadians are very familiar with the bottlenecks around permitting, zoning, and the environmental lobbies and NIMBYs at the local level that also help to restrict supply, as highlighted in the July 2024 Monetary Policy Report. What that report and others conveniently forget to mention is how the BOC is responsible for a decade of extremely loose monetary policy. Easy money, which created perverse incentives for investors and was the rocket fuel for an already speculative housing market and just what it needed to send prices to the stratosphere. BOC should hang their head in shame. Fast forward to 2025, and again, it's more promises and dubious policies. The government has cut taxes for first-time homebuyers, which is good, and they plan on cutting red tape, which is good too, but I will believe that when I see it. They have also introduced a galaxy-brained idea of getting an already bloated federal government into the business of building homes. In this case, past performance is a good indicator of future results, and so my expectations for this program could not be lower. In any event, their main claim, which you can find on the Liberal Party's website, is that they are going to build 500,000 homes, doubling the current run rate of 250,000. This will never happen. Regardless of which party is in charge, when you hear that type of rhetoric, keep this chart in mind. Canada's best year ever was 319,000 new homes started, at the height of the post-COVID bottleneck release and subsequent boom. So what's going on with prices now, and is it really still a crash? Well, when you look at the national price level, it definitely is. This chart is from Ben Rabideau, who's an amazing follow on Twitter, and shows the huge decline from the February 2022 peak. The problem is that we're only just back to 2021 levels. In reality, we have just washed out the COVID spike. Houses were largely unaffordable in 2021, and the chart shows that there hasn't really been any meaningful correction relative to history. However, the mistake we need to avoid is treating several wildly different markets as one homogeneous blob. Real estate is local in nature. And another chart from Ben typifies the problem we have when focusing on the headline index. In some cities in Ontario, there have been declines comparable with the crashes we saw in 2008 in Ireland and Spain and parts of the United States. And some cities actually have risen from the peak of 2022. Another way to think about the house price decline is in terms of affordability, and this includes the price of a house relative to income, as well as the cost of servicing the debt or mortgage. Again, it's a mixed bag across the city, but interestingly, despite the numerous BOC rate cuts, falling mortgage rates have played a small role in that change. Let this be a warning to those who think that ever more Bank of Canada rate cuts will bail them out of a crappy situation or save the Toronto condo market. The 5-year bond yield, which is where most of the mortgages are priced off of, has hardly budged over the last year, despite the major cuts we've seen on the front end of the curve. And this is because of other factors like inflation, credit spreads, deficit spending, etc. Another thing to consider is the type of home or dwelling. This next chart from Ben illustrates this perfectly. Single-family home building has been stuck at around $50,000 for about 20 years. So it's fair to say that going forward, supply will remain more constrained and support prices. But to be clear, this is of course a sweeping statement. As I mentioned earlier, it will vary by city to city. By contrast, condos and more recently, the rental unit construction has soared. These condos, many of which were bought by investors at the height of the frenzy with rock bottom interest rates. Now many of these investors are underwater, meaning they owe more money than it's worth, and there are a growing number of stories of investors simply walking away from their deposits. The epicenter of this pain is, of course, Toronto, where the condo market is seeing the biggest gap between supply and demand in history. This means one thing: prices are heading lower. The jig is up. There's too much inventory and the greater fool is gone, i.e. there's no one left to flip this condo to. Add that to the weak business sentiment and the rising unemployment, and you have a path for much lower prices in the near term. In the rental market, we are seeing a similar story. There's just too much supply. And with the collapse of the immigration-fueled population growth, the rug has been pulled on many of these developers. As a result, asking rents are falling fast, and we expect this to continue as well. In the meantime, this extreme weakness is showing up in the private lender space. As Daniel Foch puts it, the Canadian carry trade is blowing up. Rising consumer stress, unemployment, weak growth, falling equity, higher interest rates means these investments have gone from a sure thing to maybe nothing at all. There are now a growing number of stories of delays to redemptions of these funds because too many investors are all trying to withdraw their money at the same time. In short, there's not enough liquidity to cover those fund redemptions. And that's exactly why we at IceCap have shied away from including these types of investments in our portfolio. We expect there's much more pain to come. You should definitely watch this space. All right, that's a wrap on this week's episode. Please like, subscribe, and follow for more. And as always, we manage money for families all across country and the world, so feel free to get in touch.